Welcome, everybody, to the May 2013 quarterly market briefing. This is Robert Pires and Mark Melvin and Dan Rivera broadcasting to you from Bias's offices in Hamilton, Bermuda. Well, the good news for the quarter ending March 28, 2013 is that stocks, particularly U.S. stocks, have put in very good performance. Emerging market stocks were down a bit over the quarter. And particularly interesting is the decline in gold prices. U.S. Treasury bonds of all maturities were pretty well flat. But gold is what interests us in this slide, particularly the negative performance, which suggests that investors are getting more confident about financial assets in the most recent quarter, particularly stocks. Now, talking about fixed income securities, or in this next slide, U.S. Treasuries, we've seen over the past year that the performance has been pretty flat, and getting into the year-end 2012 into the beginning of 2013, we actually saw a drop in bond prices, reflecting higher yields in bonds. We think that trend is likely to perform, and in looking at various different maturities, that slide was just of indices. We have on the next slide 2-year, 5-year, 10-year, and 30-year Treasuries, and you see that the longer dated Treasury bonds actually fell in value during the quarter. The 2 and 5 years were just only slightly up, and really for our uses were flat. So we think it's time to really talk about bonds once again, particularly if we're moving into higher yields or higher interest rates in the future. We want our clients to be prepared for this. So the slide, which we've titled Trend of Bond Prices with Rising Yields, is really to show the impact of rising yields on bond prices. We've taken 3 different U.S. Treasury bonds, a 2-year, a 10-year, and a 30-year maturities. The current yield on the 2-year is 0.22%. That's about what you've been getting in your short-dated bonds. The 10-year is yielding 1.72, and the 30-year is yielding 2.91. So we wanted to show you in the yellow field to the right what happens to bond prices of differing maturities as interest rates or yields go up. And you'll see that in the first column, where yields are going up 1%, that the shorter maturities fall less than the longer maturities. And indeed, the 30-year U.S. Treasury has fallen much more, from 104,000 value down to 86,454, whereas the 2-year Treasury has fallen just to 99,038. Now, if you take the yields and move them up 3% and 5%, you can see that these bonds drop even further. So the point that we want to get over to our clients is that we are very likely moving into a period of higher yields or higher interest rates. Certainly when the Federal Reserve releases quantitative easing, there will be upward pressure on interest rates, and this could impact your bond prices or your bond valuation. So for that reason, we've kept our clients in very short-dated bonds, even though the returns on them are fairly marginal. So on the next slide, we show the impact of progressing to maturity of premium bond prices. We've taken as an example a bond issued in 1985 to mature in 2015. So that is a 30-year bond. And as you can see, in 2003, this bond that would have been issued at par, or 100%, was worth $180,000. So that's another way of saying that the bond price was $180. Now, this is an extreme premium, but we wanted to show it to you so you could see what happens to premium bonds over life. Now, what was interesting about this is that at that point in time, that 11.25% coupon was 7 5/8 higher than what the appropriate yield was for that bond in 2003. So as this slide shows, over the life of the bond, and certainly since 2003 to 2013, this bond has fallen in price, but each and every period it's paying on an annualized basis well in excess of what it should be given the market interest rates at each point in time. So to clarify, in 2003, that 11.25% was paying 7 5/8 more than what the appropriate yield was at that point in time. You progress a few years forward to 2008, you'll see that it was paying 7 5/8 more than what the appropriate yield levels were at that point in time. And bringing it closer to its maturity in 2015, we can see in 2012 that it was actually paying 10 7/8% more than what the going market rate of interest was for that maturity of bond. So that is a natural progression to have your premium bonds depreciate over time. But the good news is that you're willing to take that depreciation because of the excess yield that you're getting on that bond over what is the current market rate. So premium bonds do have their use in their portfolio. We don't want you to be put off by them, but you need to know that they are going to drift down and be a drag on the performance of your portfolio in the years to come. Okay, so how do we deal with this drift in our client portfolios while at the same time maintaining a good level of income, particularly for those clients who are retired and are dependent on the income from their portfolios? On the next slide, you'll see a risk and return profile of both fixed income and equity securities. These are subcategories, and you'll see in red, you'll see various subcategories of fixed income securities, and further out to the right, you'll see the equity subcategories in blue. On the left-hand axis, you have return. Along the bottom, you have a measure of risk. Don't confuse the rate of return percentages with the risk percentages. The risk percentages relate to volatility and price movement and have nothing to do with return. So what we see here is that indeed fixed income securities provide less risk for the portfolio. But as you extend up to the right, you see that, in fact, over the last 20 years to March 2013, that some categories, specifically the S&P 500 index and the S&P Dividend Aristocrat Index, have provided higher rates of returns. Now, what's happened in recent years is as the quantitative easing of the U.S. Federal Reserve has lowered the level of interest rates artificially, fixed income managers have pushed out their clients' risk tolerance by putting them in lower credit quality, otherwise known as higher yielding bonds. Well, they have to yield more because they are lower credit quality. Here's the problem. High yield bonds do default on interest payments from time to time, leaving investors with cents on the dollars of what they had invested. Our preference is to put client funds into the ownership of higher quality equities. That's represented by these S&P Dividend Aristocrats. These are companies that have consistently increased their dividend payments over a 25-year period. So naturally, if they can do that, they are higher quality. Now, the add-on benefit of putting investor funds there is that in addition to getting very good rates of income from the dividends of Dividend Aristocrat stocks, you also have the potential for some capital appreciation. For those of us at Bias, managing your client portfolios, this makes the most sense. So, Dan, I've done enough talking. Talk to us about global stock markets.
Well, global stock markets have really given us a lot in the last 6 months. You can see, as measured by the MSCI World Index, equities are higher in the past 6 months, and that has certainly been something that is very consistent with what you just discussed in the fixed income arena as investors search for better returns. If you go to the next slide, we have our regional equity performance here, and you can see that by and large in the last 6 months, which is in yellow, equity markets across the board have moved higher. And I think one of the pleasant surprises of this has been that in the last 6 months, Japan in particular has done very well. And you'll recall our last quarterly market briefing when we talked about how Japan was changing their direction with respect to inflation and the pricing of the yen in global markets. And it's certainly starting to manifest itself in at least improving equity markets, which foreshadows better performance going forward. But all markets are up over the last 6 months. And over the first quarter of 2013, Japan and the U.S. are leading.
In fact, we've always been very shy of Japan, have always had an index weighting because it's a difficult market to find rhyme or reason from. But we thought that with these tectonic changes in Japanese monetary policy that there would be some opportunities there.
So on this particular slide, you can see that we have 6 indicators that point us to the notion that we're going to see a market correction. Of the 6, 4 indicate that the market should retreat somewhat. Of the other 2, they still look okay. The relative strength indicators are not overbought. And equity risk appetite, which is a nice indicator that we've used for some time, does not show any real change in investor appetite. It isn't in euphoria nor in panic. So 4 out of the 6 are saying expect a correction. And we expect it to be very modest because as you go to the next slide, what you'll see here is the last four major corrections depicted. The Lehman, which everyone certainly is familiar with, but post-Lehman, there have been 3 pretty strong corrections. Each successive correction has been a smaller magnitude than the previous one, which is illustrated here. And we suggest that the maximum correction we'll face will be a correction of about 5%, which would be very consistent with this reduction in volatility and a continuation of a cyclical bull that's supported by modest but consistent economic growth. In order to reinforce the notion of a correction, if you look at the following slide, U.S. stock momentum is in fact slowing. You can see that we're approaching the top of the range. Relative strength indicators are starting to become a little bit soft and roll over. And you're seeing a rotation more into defensive as you go to the next slide.
Well, Dan, just to help out with the tech speak, because we may lose a few people, you're talking about the mark of, what's that, 1576? Yes. That horizontal red line, and the recent price chart is coming up right on that. I think it may have poked through that a little bit since we did this chart up. But what you're saying, there's some resistance there, and certainly the upper move is sort of going through a reconsideration moment right now.
I think that's a great way to put it, and that's absolutely correct. And one of the additional factors confirmed by the next slide is you're starting to see defensive securities outperform more cyclical ones. Whenever that happens, that is a pretty good indicator that you're going to get some sort of correction. And again, we don't believe the correction will be very substantial.
So to clarify, cyclicals are stocks that really motor ahead in a recovery. And this slide is charting cyclicals divided by defensive, some of which are like staples and any other sectors.
Right. Things like food stocks, Procter & Gamble, for example, versus General Electric would be a prime example.
So what we're seeing is that as the line declines, it means that defenses are outperforming cyclicals.
That's correct. Procter & Gamble's beating GE.
And so that means what?
That means that you should expect to see a correction coming because investors are becoming more defensive in their positioning and getting away from stocks that rely on global growth to move higher.
So what's surprising is what's going on in Japan.
Absolutely. Japan seems to be working, and it continues to do so. The yen's been weakening, and the expectations for improvement in exports out of Japan are very high. And there is every reason to believe that the strategy may lead to success. There has been, after all, a 20-year desertification of the Japanese equity markets. They've done nothing for over 2 decades, and this is starting to react to the changes of economic and monetary changes.
So you mentioned relative strength index. previously on a previous slide. And if you look at the red line down below, you see that the relative strength index is pretty overbought with respect to Japan. So what have we done recently, given that we've benefited from this strong move up in Japan?
Well, we have reduced our Japan equity weighting to a more neutral weight to mitigate the downturn that is likely to come as a result of the sharp and up move.
Right. So we don't want to be too greedy, but if we were to get a bit of a sell-off in Japan, we might find cause to go back in at lower levels.
Absolutely.
Okay.
Going on to the next segment, commodities have been weak. Most investors follow gold, I found, and the broad commodity indexes have been down, particularly over the last 6 months. They peaked back in November and have been sliding pretty much ever since, with a short rally in February. On the next chart, though, I think what's very important is gold is moving into bear territory. Gold has been in about a 127-month bull market, and it certainly is indicating now that some of the yellow metal has lost its luster. There are bank sales, central bank sales, hedge fund liquidations are occurring, and there has been no upward price move in gold on economic shocks, particularly Cyprus, and one would have expected a sharp recovery price move in gold on that news, and it didn't happen. If you go forward, oil supply glut is pushing oil into bear territory as well. For the first time, the U.S. is approaching energy independence. And you can see that as a result of tar sands and other supply coming on stream, you're slowly approaching equilibrium in oil prices. And moving on to base metals in the commodity section, finally, copper is in good supply. There is a surplus of copper available on the market. Capacity utilization is over 80%. And there's really no external shocks to expect the supply of copper to be in any way mitigated so that prices have a chance to rise. So there's no real inflationary movement here either.
So the backdrop is not bad, but not great.
That's correct. U.S. economy is still improving. Advanced monthly sales have been up, with autos and sales ex-autos both advancing. Residential construction, which we discussed at the last QMB, continues to move higher. We're very cheered by that because it's an important component of the U.S. economy. Monthly sales are on an uptrend, and unemployment is actually starting to decline, which is all positive for the economic backdrop in the U.S.
So the recovery in the residential construction area is constructive for copper prices.
To a degree, but recall that there is sufficient supply, and so there's plenty available, and prices are moderating.
Right. Okay.
The rest of the world doesn't look that terrible either. The Global Purchasing Managers Index, which is published by J.P. Morgan, covers about 87% of all of GDP producing companies in the world, is in a growth territory. It's certainly not in recession.
So just to clarify, when these top two indicators on this slide are above 50%, that indicates growth. When it's under 50%, it indicates contraction. Is that correct?
That's correct. Okay. Above 50 is a critical number. And the same is true of China. We were cheered to see that start to rise. It looked like their slump perhaps is behind them. And the lower two slides, the recovery is patchy, with India still mired in difficulty, but U.S., China, and the Eurozone slowly rising, with the U.S., of course, leading. Think for a minute of a tricycle, with the U.S. as a big wheel in front and China and the Eurozone as little wheels at the back.
So with the leading economic indicators, basically the number to look at is 100. Anything above 100 means that it's expanding.
Right. And then finally, global unemployment, which currently stands at 8.03%, is expected to fall, and to do so relatively sharply. So that's also a pretty good indicator that things are improving globally, although perhaps not as quickly as we would all like.
So the recent rally in stock market is probably justified based on this tentative global recovery. What do the technicals tell us?
Well, what the technicals are saying is both the 50-day and the 200-day moving averages, which is a nice way of sort of gauging the strength and the resilience of price movements, both look very good. The 50-day is well above the 200-day moving average. It still indicates prices are going to be moving higher. And that also indicates that forward-looking economic progress should be positive as well, because the equity markets usually discount economic conditions 6 to 9 months hence.
So to repeat your clarification, when this green line, which represents the 50-day moving average of the MSCI World Index, is above the red line, which represents the 200-day moving average, that is an indicator that the stock market's momentum is upward.
That's correct, and that price behavior is healthy. And to reinforce that, U.S. company profitability is solid. There has been some slowing. You haven't quite had the same revenue and sales, but it's still positive. And U.S. manufacturing still looks reasonably good. Again, that's moderating also, which seems to begun what is a traditional spring softening. But we are still optimistic that you're going to see continued performance.
Okay, well, thank you very much for that economic roundup. In the last quarterly market briefing, we introduced a new theme, which was cyber security and the crime that's associated with it. We just want to do an update there. Mark, just tell us what's going on there.
Thanks, Robert. Yes, just want to remind everyone what cybercrime really is all about. Some attacks are just pure vandalism. Many come from the USA, despite what people think. And it's going mobile, particularly when you notice this week has been the Boston attacks. There's been a hacking of Twitter, which is quite amazing. Smaller companies are easier targets than larger companies, largely because they have fewer resources to defend themselves. But the bottom line really is that the number of targeted attacks in 2012 over 2011 rose 42%. And this is a survey done by Symantec, one of the world leaders in internet tech safety, and their 2013 threat report. The FBI is taking things massively seriously. They've devoted a website to it, so has Interpol. And if you read the little bit at the bottom, it says that companies globally are losing $1 trillion a year in terms of this kind of stolen intellectual property crimes. And this is a neat thing I saw last week in the Bermuda paper. Reinsurers are actually taking interest as well. There's cyber liability policies which are becoming more and more popular. But one thing to remember about this is that it's neither romantic nor easy to actually resolve. Everyone has this notion that it's incredibly easy by clicking a few buttons to actually find out who these bad guys are. It's desperately difficult, and particularly when you've got things like the sequestration in the US and cost-cutting in the UK, for example, fewer resources are actually being devoted to this than possibly should be the case by governments. So overall, the theme is right, and there have been a couple of price declines going on in the two stocks we introduced to you last time, Fortinet and Checkpoint. Just want to talk about them. Fortinet we bought back in February time, about $23.94. We only bought a 0.5% position in the portfolio because it's a small cap, and we actually averaged in and bought another 0.5%, around about $18, just a couple of weeks ago. Checkpoint we bought 1% back in February, around about $52, but the price on that has gone down to $45 as well. And so we just want to take a little bit of time to explain what's gone on.
So the reason why we bought 1% in Checkpoint was because it's a bigger cap stock, less volatile. We expected a certain amount of volatility in these stocks, and therefore we took a bigger bet in Checkpoint being the bigger company than we did in Fortinet.
That is correct.
Which then allows us to buy more if the price sells off.
Again, correct. So we just took a look at some of the fundamentals of both stocks again, just to remind ourselves. Fortinet is, in terms of, this is a chart showing a value for money impact study on internet security. And Fortinet come right at the top of the tree in that. They are good stuff. It's not cheap by any manner of means, but in terms of value for money, it's more value for money than other players. Their growth trajectory is intact as well. Thing was that they couldn't keep it up in the first quarter of 2013, and their revenue growth fell from a runaway 30% a quarter to 23% a quarter, which is still pretty good, but not what the market expected. So therefore, it was sold off quite substantially. And seeing as far as we're concerned, there's no change to the underlying rationale of holding the company, seeing as it is a top pure play challenger in this sector, which is still expanding.
So revenue growth was 30.4%, but it's moderated back to 23.1%, but 23.1% is still good growth.
It's fantastic growth. So we just took the opportunity when the price went down to add another 0.5% to the position. So it's now just about 1%.
Okay.
In terms of Checkpoint, this chart here shows, again, it's another a Gartner research production, Gartner being a main IT security consultant firm, that in terms of being a leader in this particular sector, Checkpoint again ranked towards the very top. Comforting to see that Fortinet ranks as a top challenger in the group as well, so it's nice to know. Their growth trajectory is still very, very strong as well. Not as much as 30% a quarter maybe, but it's still pretty strong. But they again reported slowing sales, and this 3% quarter-on-quarter sales growth in the fourth quarter was the slowest in the last 4 years. The thing is that this stock is trading at a realistic price. It's still only about 15.5 times earnings from a PE, but its return on equity is 20% thereabouts. Got no debt, got loads of cash, and it's buying back shares. So it's a leader, it's cheap, and it's got a stock buyback program in place. It really ticks all the boxes for us. So our conclusion on these cybersecurity stocks is really fourfold. The theme's intact, but the thing to remember is the price momentum is volatile. Fortinet is, being a small cap company, we expect to be more volatile than Checkpoint because their revenue flows vary. Checkpoint is larger, so they're far more consistent in terms of revenues and earnings generation. Both remain the best pure-play cybersecurity stocks in this particular sector. Both stock prices were pulled down by the broad market sale of tech sector stocks, which has taken place in the last few weeks. So the one way that we actually control the price risk in these stocks is we buy in small pieces and we then add on a gradual basis. Our target allocation for these stocks is around about 1.75%. And just to repeat, we got about 1% in Fortinet and the same again in Checkpoint.
All right. Well, thank you, Mark and Dan, and thank you for our listeners who have tuned in from around the globe. We'll get this out to you in the next week or two. And if you have any questions, you're welcome to email us, either one of us. The email address you can get online at www.bias.bm or www.bias.ky. We'll look forward to speaking to you again. The next session will be in November. And for those of you that cannot attend in Bermuda or Cayman, we'll get it out to you via the web. Thank you so much and take care. Have a wonderful summer.